Hello everyone, welcome to this week's market analysis session. My name is Carl Capilingua. I'm the market analyst over here at ThinkMarkets Australia, and it is a pleasure to be with you as we delve into all of those key events in markets last week and then have a look to the week ahead. Let's kick off with crypto and another tough week for cryptocurrencies. We can see Avalanche down 23.5%. Solana, the other layer one Ethereum killer potentially, well, that's what people thought they were going to be, down 19%. Cardano down 15%, and the others sort of falling away from there. The one I really wanted to talk about was Ethereum, down 13%. Now, obviously, a lot of the DeFi protocols were down, but when we compare Ethereum's 13% fall to Bitcoin's 4.3% fall, this is a bit of a decoupling between these two. They have been moving very closely together, but last week we saw Bitcoin's relative strength, if you could call it that, with a 4.3% fall, significantly outpacing Ethereum's loss. Fear and Greed Index at 14, roughly the same as where it was yesterday and last week. So if there is any silver lining, it seems that it can't get any lower, but we are certainly gripped by crypto winter here. The only green on the screen is a TRON, which I've added to the list this week, taken the lunar off, and it is one of those layer one DeFi protocols. It is storming up the DeFi charts. I think it's about fourth now with about 4.5–5% of DeFi. So certainly one to keep an eye on. It's talked about it on Cracking Crypto on Ausbiz. You might want to catch that recording on their website on Monday as the only, quote unquote, the only crypto in the top 100 by market cap that was in a short-term and long-term uptrend at that stage. So fortunately for me, it actually closed out the week reasonably well, and we can see a 1 month gain there of 28% and a 1 year gain of 12%, which is rare amongst its peers. Having a look at the Bitcoin market dominance, I think this is an interesting chart as well, kind of speaking to, I guess, how poorly Ethereum is doing, but how well Bitcoin is doing against the rest of the cryptocurrency universe. We can see it's below 40 at the start of the year, now in the high 40s, telling you that there is this centralization now, this flight to the perceived quality in Bitcoin, and perhaps even this idea that, well, Bitcoin is here to stay. Some of the other cryptos potentially not, but this confidence that Bitcoin will still be around as this long-term store of value, this idea of digital gold. Having a look at the technicals for Bitcoin, we can see that 25,365 is still holding. That's a little bit of a relief, I think, for the entire crypto universe, because if Bitcoin were to break that, I think it would just really precipitate some even heavier falls everywhere else. But we talked a couple of weeks ago about this idea that this huge surge in volume on this decline and then rally indicated a little bit of a changing of the guard. So forced selling through here during that lunar debacle, as those holdings of Bitcoin had to be sold to try and defend the lunar ecosystem. We know that how that played out. But that selling, that forced selling, was taken up by, quote unquote, the whales in the market that really soaked up that supply. And when the supply had evaporated, prices were able to recover. Now, we've seen prices tail away since then. That's a little bit disappointing. We haven't been able to go on with it. But given the broader backdrop of just how negative the rest of crypto has been, I'm taking some heart in the Bitcoin price action or lack of a response to the downside. We'll see Ethereum's response in a second. A couple of decent candles over the weekend, although I don't place a whole lot of stock in weekend candles. I really need to see it get above, say, 30.5, which is that little peak there, but preferably to change the short-term trend and induce a little bit of FOMO back into the market, this fear potentially of missing out on the key low in Bitcoin, hopefully for this year. We'd like to see it close above 32,992, and preferably, I'm going to say, 34,329. So plenty of work needs to be done here, unfortunately, to get Bitcoin back on the winners list for the year and then to hopefully get some momentum from there. Having a look at Ethereum, we talked about the more severe response here on Ethereum. Instead of sort of holding above those key lows there around 1700, coming back and plumbing them. So we see that little low there on Friday at 1702. Again, a little bit of a bounce over the weekend, but not getting too excited. I think this trend is far better entrenched to the downside than Bitcoin, and that is concerning for holders of Ethereum. Long-term trend also now looking very set to the downside. I think 2163, 2300, potentially even a close above there would be required to even start to get me to think that the low in Ethereum is in. Otherwise, the most likely scenario, and I hate to say it, is that we break through 1702 and we plumb potentially even the 1500 handle from there. So a little bit disturbing on that one. Something that is less disturbing, maybe a little bit hopeful here, and don't tend to mention that word too much with crypto anymore is the TRON chart. We can see the short-term uptrend, and that long-term uptrend is starting to change from this sort of neutral setting potentially to an uptrend if we can confirm this little hook higher here. So yes, we're above it, that's great. But if we can confirm one more little hook higher, I would say that we have turned this long-term uptrend from potential supply, now confirming into potential demand, and we could potentially get up to that maybe 10-cent level from there, and potentially even go and test those highs around 13. So a little bit of demand coming in here with these lower shadows. That's encouraging. Maybe a close above, or let's give you an aggressive and a conservative case. So let's say that high there, probably a close above 8.5, and we would say that the demand's back in. But if you're more conservative, you might go above that little peak there. It's probably going to be about 0.885 or so. Having a look at stocks now around the region here in Asia, we can see Nikkei, Shanghai Composite and Hang Seng relatively flat compared to the massive gains in the US. Now 6-7% gains in a week is totally unusual. I mean, it would be an absolute outlier if you put it on the bell curve, no doubt, way towards the end of the curve there. So I think it does speak to something significant going on in US markets, and obviously we'll look at those charts in a second. Volatility falling 13% for the week. We can see the VIX index now 4 weeks down in a row, but still somewhat elevated, I would suggest, compared to where we like to see it in those sort of mid-teens, to indicate that the market is in a relative state of calm. European markets getting a little bit of a bounce on the back of those US markets. Having a look at some of the technicals now for the US indices, we can see that we have seen, Monday, Tuesday, Wednesday, Thursday, Friday, some extraordinary gains there, and more importantly even than that, closing at the high on Friday. So big up weekly candle, also taking out that short-term potential supply zone here, the dynamic resistance, and targeting now potentially this long-term dynamic resistance at 43.09. That's probably the next upside target from here. Looking to the downside, what areas could turn into support? Well, this little peak here around about 4,100 will come into play potentially. From there, we don't want to see it get too much lower, and really it's all about probably the 4 handle now. Holding that on any dip would start to confirm in the market's mind that we are back into this buy the dip phase. So if we talk about what a bear market is and what a bull market is, bear markets are really all about selling the rally, waiting for better prices to get out. Bull markets are all about buying the dip, waiting for better prices to get in. And until we can change that psychology of the market, or at least see it change, let's face it, many investors are waiting to see what other investors do. If they see other investors start to buy that dip, then they will jump on board as well, because we're going to start to get some of that FOMO back in the market, that fear of missing out. But not fear of missing out as we saw up here as we're making the highs, fear of missing out in blue sky. It's more fear of missing out on the bargains and getting that cash to work that a lot of people had been building up in anticipation that there was going to be this big bear market or market correction. Now that cash, the prices starts to go back up, is at risk of being underutilized. And don't forget, at 38.10, that's official bear market territory. Now, we didn't close there, okay? And a lot of people were waiting for that to happen. It finally got there, and they didn't get the chance to buy. The market rallied too quickly for them. So there will be cash on the sidelines, quite literally waiting for that next signal. And I keep focusing on this area here as potentially where that next little pullback and rally could come from. Now, I'm only just focusing on there because that's where that short-term supply zone is. But looking at Friday's candle, it could end up being a little bit higher because that close is so strong. Now, we're not going to get a session this evening in the US because they're closed for their Memorial Day holiday, but it's really all about what happens in here. So more white candles, we're going to head up to 43.09. A bunch of black candles in here. Well, that could be interesting because it could indicate that this is a bit of a false dawn and we may be heading back down to the lows. So I know I'm hedging bets a little bit, but the candles will dictate. The candles will tell us what we need to know. So white candles in here, we're heading back up to 43.09. Black candles in here, then you want to be a little bit more cautious. If we saw, say, some lower shadows in here, so not necessarily big black candles, but some lower shadows pushing back in to that sort of 4,100, 4,000, and then the white candles resuming, then that's your buy the dip. That's your big signal, I think, to get some money back in the market. Have a look at the NASDAQ. Not as well progressed, is it, as the S&P 500. This, of course, is the risk-on end of the US spectrum. And it has done pretty well, though. Let's face it. The closing in that potential supply zone at its highs on Friday is all good stuff. Again, I keep sort of drawing this sort of price action with my pointer there, isn't it? It's the kind of price action we want to see that will confirm the low is in. A trough here with these candles confirming that low is in, moving the market back into buy the dip and getting a bit of FOMO going as well that we may well have missed. This massive buying opportunity, okay, this fear that we'll never see prices that low again. So key levels, I'm going to go on this one. Well, 12,203 I think is obvious, but maybe even for safety, 12,555, close above there. And I think we're starting to look pretty good again. Having a look at some of the base metals prices now, we can see pretty mixed week there, but overall, I think we're sort of heading back in the right direction. Iron ore prices, we can see also generally heading in the right direction. I like this little inverted head and shoulders pattern here forming. And we've got a rise in neckline. That's always pretty good. Some of the candles with the lower shadows in there, that one there, little white ones in here. I think it's starting to look pretty constructive actually for 120. Being a bit of a pivot point here. So obviously 171, 120, and potentially moving back. We'll see how we go at 150, close above. That would be very constructive. You can see that little peak there at 148, but hey, let's face it, anything above 120 is good for our big iron ore miners. Having a look at copper now, obviously also has a big impact on a lot of our big resources stocks. This one I'm a little bit more concerned about. Yes, there is that little inverted head and shoulders forming, but I want to see us get above this potentially substantial supply point here. So starting from 95.01, probably going into sort of 98.26. It's the conglomeration of these key potential supply zones, short term and long term. Close above that, I think we're heading back up to those highs. But if we start to see these peaks getting put in around here, that would be concerning. Sort of these lower peaks forming in that zone. Having a look at nickel, actually looking like it's stabilizing here. We did expect it to pull back to the long-term trend zone. It has done that, and for all intents and purposes, I think it looks pretty constructive. Probably a close above this level here, say 29.5, maybe for safety 30,000, to tell us that we can move back into sort of the neutral zone since that big spike around about 34,000. Gold, not a whole lot to talk about here. I think it really is stuck in the doldrums. I can't see really consistent candles to the upside. I can't see great price action, and the trends are pretty mixed right now. So for me, I think gold is just a non-event at the moment, neutral at best. Something that looks great though is the price of West Texas Intermediate crude oil, and it's just a wonderful trend. That short-term trend, long-term trend, well established to the upside. Some really nice candles coming in. I like these, this big lower shadow here, a couple of nice white candles coming in late in the week last week, pushing into this 116.60 level, which I think if we close above that, we could see prices move back up to those old highs. But the trend is your friend, and I think you need to trust that one. Having a look at the currencies now, we can see the Aussie dollar rallying along with many of those majors as the US dollar index did come off a bit. And that's good for markets because the US dollar index is generally considered to be a key risk-off indicator. So an easing there would indicate that markets are becoming a little bit more confident about this situation. Bonds were largely mixed, maybe US yields down a touch there. We'd see Aussie yields still at elevated levels, no doubt, but starting to moderate around that 3.2. US yields, I think, look more convincing for a move to the downside, or at the very worst, I think a stabilisation around these levels. But I'm going to say we have seen peak rates here. I think the technicals are pretty clear on that one. Bringing it back home and having a look at Aussie stocks now, it was a pretty quiet week, although I expect us to do pretty well on the back of those gains in the US on Friday today. Energy sector, the standout there, up 2%. We saw that wonderful looking crude oil chart, I think, helping out there. Financials doing pretty well, up 1.3%. The other key standout there, the material sector, as we saw the iron ore price improving. Properties also up a little bit as some of those long-term yields are coming down. The rest of them not great. I mean, gold continuing to struggle. We talked about why. Information technology still struggling there, but probably we'll get a bit of a pop this week on the NASDAQ move. There was some takeovers that were put on the table and taken away on Appen, which probably didn't help on that one. Otherwise, volatility coming down. We can see a general short-term uptrend here. It is pretty wild though, isn't it? With some pretty big black candles and white candles coming in, pushing into this potential double supply zone here of the short and long-term moving averages. 72.33, the key level for this week. I do think we'll get a close above that probably today, or hopefully above that today. And then if that occurs, maybe even we can consider 74.35. If we don't get a close above that, in fact, if we get a rejection, so we start well today and see a big upper shadow coming in to fail to close above 72.33, potentially indicating that there's still some pesky supply in the system that, if it builds, could actually see us come back to 69.30. So it's all about the candles today, maybe even tomorrow and the next day. Some nice white candles, strong closes, and we will head back up. Some upper shadows, black candles in there, and I do believe we are going to have another leg down. So, watch the candles, they'll tell you what you need to do. Having a look at the valuations within the Aussie market, we're at 14.3, which is, still well down from our post-COVID peak of 20.1, and in fact, well down from our 3-month average prior to COVID of 15.7. And if you look at the markets in 87, for example, or in 2007, we saw major corrections in the Australian market. Those 1-year PEs were over 20, even 22 in some instances. So I think what's helped us avoid some of the losses seen elsewhere in the world is that Aussie stocks really weren't that expensive to start off with. Cheaper sectors, still energy, I think they're 7.8, very low compared to its historical averages, as is materials, utilities looking pretty cheap there in comparison to their long-term averages, also property trusts. What about technology? One of the key questions I get asked every week is whether tech is cheap enough to buy. Well, look, certainly down from last month, 36.1, less than half of its post-COVID high at 77.4, but still above its long-term averages. Look, it's getting pretty close, isn't it? But you would say cheaper, but not yet a bargain. Having a look at the technical analysis factors now for the Australian market, what we're looking here is the proportion of stocks in uptrends over various technical analysis look-back periods. So we can see 5 periods would be 1 week, 10 is 2 weeks, 10 trading days in 2 weeks, 21 trading days roughly in a month, 2 months, 3 months, and then all the way out to about a year. And we can see that roughly 2/3 of stocks are trading below their 1-year trends. And that is not a great sign. It's only really until we get to the very short-term periods that we're getting any close to sort of balance there in terms of stocks above their trends versus below their trends, and we're a long way off where we need to be. So we want to be up here, and about 2/3 of stocks trading in uptrends over those periods. So plenty of work to do. Maybe it'll happen this week with some of those positive overseas leads, but I think that is a very good reflection of what we're seeing here, which is the fact that as hopeful as we get from time to time, the trends speak for themselves, and sectors like discretionary still very well set to the downside. Gold, technology, property, staples, telecoms, all very strong downtrends. Doing better, energy, we talked about how that was one of the cheaper sectors as well. We talked about strength in the crude oil price. Financials, stalwarts of the Australian market, really helping us hold on to many of those index points. Materials starting to look better, with some improvement in some of those key industrial metals. Utilities still looking very strong with its trends up. We've talked about AGL, APA and Origin as the 3 key picks in that sector. Having a look at some of the economic data from the week, we had the Purchasing Managers Index come out for the manufacturing and services sectors here in Australia. Let's have a look at some of the numbers. The composite index, which combines both sectors together, at 52.5, which indicates growth. Anything above 50 is indicating growth, anything below 50 is indicating contraction, but it was down from April's 55.9. So yes, we saw the 4th consecutive month of growth for the Australian manufacturing and services sectors, but at a slowing pace. I think that's the key theme there. In terms of services, that came in at 53, again down from the previous month's 56.1. Manufacturing output actually fell into contraction territory, 49.3 versus April's 54.1. A lot of that to do with floods, but also persistent supply chain constraints and increasingly competition for labour, causing manufacturers to struggle getting product out the door. Now, overall, the manufacturing PMI came in at 55.3, which is pretty strong, down from 58.8 in April. But the confidence is there because new orders remain robust. Firms are building backlogs of stock to combat disruptions, and their orders backlogs remain strong. So whilst output is down, that is seen to be temporary. Having a look overseas, and particularly in the US, this is the Fed's preferred measure of inflation. That's why it is crucially important for markets. And I think this is one of the key reasons why markets in the US rallied last week. So the monthly data for April came in at 0.3%, and that was in line with the expectations and about flat with March's reading. And when you go back 12 months, you take 12 of these bars and add them together, the reading for April was 4.9%, and that was cooling from March's 5.2% rate. So we're heading in the right direction to get the inflation rate in the US back to 2%, and that would trigger the Fed to remove some of their tough rhetoric on interest rates. So good news there, and markets took heart. Having a look at some of the other data the Fed looks at very closely, expenditures, they were pretty good actually, up 0.9% compared to 0.7% expected, a little bit down from the previous months. Reading into it though, some of the gain was simply because things cost more, so that's a little bit concerning. Also a little bit concerning, but also helpful for interest rates, is the fact that wages aren't exactly booming at this point in time. So we saw personal incomes go up by 0.4%. That was less than expected and less than the previous months. So we're not seeing this runaway cycle with inflation and higher wages, which then causes more inflation, which then causes higher wages. But the bit that's not so good is the fact that consumers are losing spending power. So we know inflation over this period has been significant, and yet wages really haven't kept up with those price increases. So we're going backwards in terms of what we can afford. Having a look now at the FOMC meeting minutes for May, very interesting. Now, they did increase interest rates by 50 basis points at that meeting, but the notes suggested that most participants were quite keen to continue to increase interest rates at a rate of 50 basis points for the next two meetings, and that would take the official Fed rate to 1.75% to 2% by July, which I feel is a rather neutral setting, to be fair. And the Fed up to this point has been talking about this goal to get back to neutral, so effectively to take their foot off the accelerator, not necessarily to put their foot on the brake. But however, members noted that inflation risks remain skewed to the upside. They are worried that higher inflation could become ingrained and potentially spark off that inflationary spiral that I talked about, where prices are up, wages are up, prices are up, and so on. And if that were to occur, they may have to move to a restrictive stance. Now, they haven't used that terminology before. This idea of neutral has been around, but worryingly, now talking about maybe they need to get restrictive. I think the data suggests they don't have to do that, and that's why markets were up this week. Having a look ahead, clearly the biggest event on the Aussie calendar is going to be the GDP coming out on Wednesday. Have a look overseas. We can see some manufacturing data coming out in China. That should be out tomorrow. We do have the bank holiday in the US for tonight, our time. European CPI data, inflation data, very important, but otherwise, let's face it, the biggest data for the week is going to be down here, the US employment data. The ADP reading coming out Thursday there, and then the official data coming out on Friday. Now, I'll be back tomorrow at 1 p.m. tomorrow, Tuesday, Sydney time, for Ask the Experts. That's where you get to ask me anything you want about your portfolio, and I'll give you a quick technical and fundamental reader on those. We have lots of fun. We learn lots as well, so make sure you register at that address and join me. Other than that, ThinkMarkets has a fantastic offering for traders, whether you're ASX share traders, you're trading overseas shares, indices, commodities, over 4,100 products across our shares and CFD offering. Also, an industry-leading platform with all the features you could ever need, and fantastic customer service as well. Head to the website and make sure you register for an account. You could be trading in minutes. If you're watching me on YouTube or any of the other socials, please hit the subscribe button or the bell icon to remain notified of any new content, and make sure you smash that like button to let us know you love what we're doing, so we'll continue to do it. Apart from that, it has been a pleasure chatting with you this morning. All the best for your investing until we catch up again. Bye-bye for now.